Hello financial fans, welcome back to another stock analysis. Today we'll be covering Home Depot stock ticker HD. Home Depot is a well-known retail company that specializes in providing a vast array of home improvement and construction products. They offer an extensive selection of items ranging from tools, hardware and appliances to building materials, lighting fixtures, plumbing supplies and gardening equipment. With a focus on serving both professional contractors and do-it-yourself enthusiasts, Home Depot aims to provide customers with the tools, materials, and expertise needed to complete various projects related to home renovation, construction, maintenance, and enhancement. Their large store locations, knowledgeable staff, and online platform make it convenient for customers to find and purchase products necessary for their specific needs. The company is currently sitting at a market cap of $318.2 billion, and their revenue in 2022 is sitting at $157 billion. And the dividend yield is currently sitting at a very nice 2.64%. 40% of their revenue comes from building materials, 28% from decor, and remaining 32% from hard lines. To determine the final valuations, the company will be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 columns in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from almost $9.2 billion in 2013 to $24 billion in 2022. The average EBIT growth during this period was 11.5%, which is no change in the margin of safety. The margin has also gone up over the years, going from 11.6% in 2013 to 15% in 2022. The average margin growth is 3.2%, which is a 5% deduction in the margin of safety. The next two metrics are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $1.56 a share in 2013 to $8.36 a share in 2023. The average dividend growth during this period is 11.5%, which is a 5% deduction from margin of safety. This with a payout ratio that's sitting at 47.5%. which is no change in the margin of safety on this metric. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, you have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Home Depot, this is just under 2 years, in this case a 176% debt to EBITDA ratio, which is no change in the margin of safety. The return on invested capital for Home Depot is sitting at a very nice 33.4% return on invested capital, indicating that the management is very effective at allocating capital, which awards them with a 5% deduction from margin of safety. Looking pretty good so far for Home Depot. Let's take a look at the valuation models next to determine the intrinsic value of the company. The first valuation model we'll be using is the discounted cash flow model. I've imported free cash flow of Home Depot going from 2013 to 2022. The average growth rate in the free cash flow annually during this period was almost 12%, and I'm projecting a future growth in all of the free cash flow for the next 10 years of 8% annually. With this percentage, we'll determine the future free cash flow for Home Depot and determine the terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $291.4 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $243.8 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $241.43, which is almost a 24% downside out of this model. The next model that we'll be using is the dividend discount model. I've imported the dividend payouts of Home Depot going from 4 years ago to the current year. On average, the growth rate during this period was 11.3%, and I'm projecting a growth rate in all of their future dividends of 6%, and will once again be using a discount rate of 8.5% in the valuation, giving us a dividend discount model price per share of $354.46, which is a 12% upside out of this model. The third model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Home Depot is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. Looking at all of these metrics, we get a fair value of $180.73, which is almost a 43% downside out of this model. The next model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Home Depot and look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 23.60. All you have to do to get a fair value out of this model then is to multiply by the earnings per share that Home Depot is generating, which is $16.43 a share, giving us a fair value of $387.70, which is a 22.5% upside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.13%, while the current yield is sitting at 2.64%, indicating that it's currently undervalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 20.5 for the past 5 years, and currently it's sitting at 19.26, indicating that it's once again slightly undervalued on this metric, giving us a fair value of $364.26, which is just over a 15% upside from the current price. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, again, that self-promotion out of the way, let's look at the final overview of a valuation next. Looking at the final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $305.72. Our margin of safety we've determined earlier using a standard margin of safety of 25%, deducting by 5% for the margin growth, 5% for return on invested capital, and 10% for the dividend growth, giving us a margin of safety of 5%. Applying this margin of safety, we get a fair value of $290.43, and with the current price of $316.50, we get a downside of 8.24%, indicating that it's currently a sell. It says here a buy, I don't know why it's saying that, but it's supposed to be a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.